For decades, Warren Buffett has been the calm in the storm, an anchor for investors through every crash, bubble, and economic crisis. But now, as he prepares to step down as CEO of Berkshire Hathaway, Buffett is making moves that are sending an unmistakable message. It's not just a portfolio shuffle. It's a warning. His message isn't buried in technical jargon or economic theory. It's simple, clear, and chilling. The United States currency is at risk. And for someone who has spent his life telling people never to bet against America, this shift should make all of us sit up and pay attention. At the heart of this warning is not a single stock pick or quarterly earnings report, but something far deeper, a systemic concern about the long-term sustainability of U.S. fiscal policy and the strength of the dollar. The moves Buffett is making today echo the strategies he used in 2003, just before the dollar slid for a decade and the U.S. market returned nearly 0% in real terms. That was a lost decade for investors. And he's suggesting that history may be preparing to repeat itself. The moves behind the message. Let's begin with a critical clue. Buffett's decision to invest heavily in 5 major Japanese trading companies, a total bet of $23 billion. But it wasn't just what he bought that raised eyebrows. It was how he bought it, using Japanese yen instead of U.S. dollars. This wasn't just a stock play. It was a currency hedge, a signal that Buffett doesn't just believe these Japanese companies are undervalued, but that the U.S. dollar itself may be overexposed. To understand the weight of that signal, consider his own words from 2003. To hold other currencies is to believe the dollar will decline. Coming from Buffett, a man who has spent decades extolling American resilience, this isn't just a financial maneuver. It's a philosophical shift. In the early 2000s, that shift preceded a massive decline in the U.S. dollar and billions in profit for Berkshire Hathaway. He saw the warning signs before, and now he's seeing them again, from patriot to pragmatist. Buffett has never been shy about his belief in the American dream. His famous line, "Never bet against America," has become something of an investing mantra. But belief, even strong belief, has its limits, especially when the data suggests that risk is growing at the very foundation of the system. The U.S. government's fiscal policy, its pattern of spending more than it earns, has reached levels that even Buffett can't ignore. He's not worried about a short-term dip. He's not reacting to headlines. He's responding to structural instability in the system itself. Here's the context. The U.S. has run fiscal deficits nearly every year for decades, but since 2020, those deficits have exploded. In 2020 alone, the government borrowed nearly 15% of GDP, a figure not seen since World War II. Though that spike came down, federal spending has remained elevated. In the current fiscal year, the U.S. is expected to run a $1.3 trillion deficit. That's roughly 10% more borrowing than the year prior. And here's what really worries Buffett, and should worry all of us: the quality of that spending, borrowing without building. There's a key distinction between borrowing to invest in the future and borrowing just to stay afloat. In the post-World War II era, high borrowing was used to build infrastructure, fuel innovation, and grow the economy. That kind of debt pays for itself over time. But today, a growing percentage of government spending goes toward interest on existing debt. In 2019, interest payments accounted for 8% of federal spending. By 2024, that number had ballooned to 13%. Projections suggest that by 2040, over a quarter of every federal dollar could go toward debt interest, money that builds nothing new. This isn't a hypothetical risk. It's a mathematical one. The Government Accountability Office, GAO, projects that U.S. debt could soon exceed 2.5 times the country's entire GDP, creating a dangerous cycle where growing debt fuels even more interest payments without adding value to the economy. Buffett knows this game. He's seen it play out in countries that lost control of their currencies and triggered economic collapses. When he says the value of currency is a scary thing, he's not being dramatic. He's telling us that trust in the system is cracking. Trust currency and the market. Currency is built on confidence. When that confidence erodes, it doesn't just affect exchange rates. It impacts everything: investment, trade, global cooperation, and market performance. One of Buffett's deepest concerns is the DXY index, which tracks the strength of the U.S. dollar against other major global currencies. This index doesn't show what a dollar can buy. It shows how the dollar is performing in relative global terms. When it falls, it signals that foreign investors are pulling back, and history shows that it often precedes periods of weak or negative returns in U.S. stocks. This isn't speculation. During the last major DXY decline, beginning in 2003, Buffett's contrarian bets paid off handsomely, while U.S. markets stagnated for nearly a decade. Today, he sees a similar pattern emerging. But this time, the stakes might be even higher. The bigger picture, debt trade and geopolitical shifts. One element that makes today's situation different is the global distribution of U.S. debt. A growing portion of it is now owned by foreign countries, many of them also the U.S.'s biggest trading partners, including China, the United Kingdom, and Japan. And here's the kicker. The same Japan that Buffett is now heavily investing in holds over $1.1 trillion in U.S. debt. That's not just coincidence. It's part of a deeper trend. Buffett is moving money toward the very countries the U.S. relies on for financial stability. That's not fear. That's strategic repositioning. If those countries begin to lose confidence in the dollar, whether due to rising deficits, trade tensions, or geopolitical shifts, the consequences could go beyond market stagnation. We could be facing a funding crisis or even a full-blown currency correction that hits the stock market hard. What comes next? Buffett has always believed in data over drama. He's not issuing this warning to provoke panic. He's sharing it because, for those who listen, it could be a signal to prepare, not just for a correction, but for a change in the rules of the game. So if Buffett is moving away from the dollar, hedging his positions, and investing in stability while the rest of the market chases risk, maybe it's time to ask ourselves, what should we be doing with our own portfolios? We'll explore that in Part 2, where we'll break down Buffett's 3-part playbook for navigating the road ahead, and how regular investors can follow a strategy without needing billions in the bank. But before we continue, think about this. When was the last time you checked the foundation of your own financial strategy? If this video sparked new thoughts or concerns, take a second to drop your perspective in the comments. Have you been adjusting your own strategy lately? Let's open up a conversation below. And don't forget to like and share this with someone who needs to hear Buffett's final warning. In Part 1, we explored how Warren Buffett's surprising investment decisions are less about stock performance and more about a growing concern that the U.S. dollar and the system that supports it is quietly deteriorating. Now we turn to a deeper question. Who actually holds America's debt, and why does that matter more than ever? Buffett isn't just tracking numbers. He's reading the pulse of a global system built on confidence. And once that confidence begins to shift, everything else, stocks, bonds, currencies, trade, starts to realign in sometimes violent ways. Let's dive into what Buffett sees that most investors miss. Who owns the debt and why it matters? It's a simple question with massive implications. If the U.S. owes trillions of dollars, who are the creditors? A large chunk of the debt is held domestically by U.S. citizens, pension funds, banks, and corporations. On the surface, this looks stable. After all, wouldn't you rather owe money to yourself than to someone who might call in the debt unexpectedly? But that's where the illusion begins. As the U.S. government keeps borrowing at unprecedented levels, domestic investors may eventually reach a limit in how much debt they can or are willing to absorb. Think of it like inflating a balloon. At first, it stretches easily, but keep blowing, and eventually it bursts, or you have to pass it to someone else. That someone else is foreign investors. And here's the catch. The more reliant the U.S. becomes on other countries to finance its deficit, the more vulnerable it becomes to outside influence. The global stakeholders, Japan, China, and the U.K. According to recent data, the 3 biggest foreign holders of U.S. Treasury securities are Japan, $1.1 trillion, China, $867 billion, United Kingdom, $655 billion. Let that sink in. The very countries that form the foundation of global trade, including geopolitical rivals like China, are holding the reins to America's borrowing power. Now remember, Buffett recently placed $23 billion in Japanese companies. And he did, so using Japanese yen. Coincidence? Highly unlikely. Japan, with relatively low inflation, a stable political system, and a currency long considered a safe haven, offers a hedge not only in stock performance but in currency security. Buffett is essentially saying, if trust in the dollar declines, I'm holding an anchor in the storm. And Japan isn't just a passive player. It's a central node in this financial web. Should confidence waver and Japan choose to rebalance its holdings, reduce exposure to U.S. debt, for instance, the ripple effects could be massive, a subtle shift in global trust. Back in 2003, Buffett warned that the U.S. trade deficit could empower other nations to control America's financial fate. Today, we're living through the evolved version of that warning. Now, it's not just about the trade gap. It's about credit dependence. The United States is, in many ways, the most creditworthy borrower in the world. But creditworthiness is a matter of reputation, not entitlement. And reputations can change. If foreign governments decide that U.S. fiscal policy is unsustainable or that trade tensions are too volatile, what happens next? They might begin demanding higher interest rates for lending. Or worse, they might begin pulling back. Buffett's positioning in Japanese equities, paired with his reduced exposure to U.S. stocks, looks less like a prediction and more like a defensive formation. He's not waiting for the storm to arrive. He's reinforcing the structure before the first drop of rain. Tariffs, the spark that could light the fuse. Let's talk about tariffs. Tariffs have been a major talking point in the financial world lately, but few truly understand how they tie into Buffett's concerns. Here's the short version. Tariffs are taxes on imports. In theory, they can protect domestic industries and reduce trade deficits. But here's the catch. If used recklessly, tariffs can spark retaliation, disrupt trade flows, and reduce foreign confidence in a country's economy. Buffett himself has said that tariffs can be interpreted as acts of economic aggression, and if they're applied without care, they might provoke exactly the kind of disruption that weakens the dollar's global standing. Combine that with ballooning debt and slowing domestic growth, and you have a dangerous formula. Spending more, earning less, and scaring off the very people who finance your deficits. Losing the dollar's safe haven status. For decades, the U.S. dollar has enjoyed the prestigious status of the world's reserve currency. That means central banks around the world hold dollars as a core part of their reserves, and most international transactions happen in USD. This position has granted the U.S. incredible power, allowing it to borrow at low rates and run deficits without the usual consequences other nations face. But that trust has its limits. In 2025, a Deutsche Bank report warned that the dollar's safe haven status is eroding, and its role as a dominant global reserve currency is under review. This isn't fear-mongering. It's a signal from the institutions that build monetary systems. If global markets begin to believe that the U.S. can no longer responsibly manage its debt and fiscal future, they may begin to shift reserves toward other currencies like the euro, yen, or even digital assets. That shift could trigger a sharp drop in the DXY index, capital flight from U.S. markets, sudden, destabilizing spikes in interest rates. In a worst-case scenario, it could be the catalyst for an economic chain reaction, the ticking clock. Many experts have described this situation as a ticking time bomb buried beneath the surface of the U.S. economy, not because they believe a crash is imminent, but because the conditions are in place. Structural debt, global interdependence, fragile trust. Buffett doesn't use such language lightly, but his actions suggest that he believes the clock is ticking, and that prudent investors should begin adjusting now, not after blast. So what does he recommend? What is his actual playbook for dealing with this risk? That's what we'll uncover in Part 3. Concrete strategies backed by decades of wisdom to help everyday investors protect their portfolios and even find new opportunities in the storm. But before you move on to the final part, I'd love to hear what you think so far. Do you agree with Buffett's concerns? Have you noticed any signs of instability in the market? Share your insights or questions in the comments below. And if this helped clarify things for you, consider giving a like or sharing it with someone you care about. Your perspective might be the one that helps someone else connect the dots. We've walked through the signals. We've broken down the risks. And we've seen how Warren Buffett's final years as CEO of Berkshire Hathaway are marked by caution, not panic, but intentional preparation. Now it's time to explore what Buffett is actually doing with his money and how you can apply the same strategies, even if you're not managing billions. Let's unpack the three-part playbook that Buffett is quietly following and how you can use it to build resilience, unlock growth, and protect yourself against a future where the rules of the game might be very different. 1. Diversify beyond the dollar. This is perhaps the clearest signal Buffett is sending. He's reducing his exposure to the U.S. dollar and increasing his investments in foreign markets, currencies, and companies. Why? Because diversification is no longer optional. It's urgent. While the average investor may not have direct access to Japanese conglomerates or foreign currency bonds, you don't need Buffett's capital to follow his lead. You can start by looking at international ETFs that provide broad exposure to non-U.S. companies. Here are a few examples. VXUS, Vanguard Total International Stock ETF. SCHF, Schwab International Equity ETF. ZILX, Fidelity International Index Fund. Studies across decades consistently show that international diversification reduces volatility and improves long-term returns. It's about having geographic flexibility, so your portfolio isn't tied to the fate of a single economy, no matter how powerful it may seem. Buffett isn't abandoning U.S. markets, but he is hedging his exposure. And in today's world, hedging is wisdom, not fear. If your investments are still 100% domestic, consider reallocating just 10 to 30% toward international assets. This one change can dramatically reduce your risk profile without sacrificing growth potential. 2. Build cash, not to hide, but to strike. Buffett is sitting on a record $300+ billion in short-term U.S. Treasuries. That's not a defensive crouch. It's an offensive stance. He's not hoarding cash to avoid risk. He's holding it because he knows something simple and powerful. The best opportunities appear during chaos, and only those with cash can act quickly. You don't need to hold billions to use this principle. If you can increase your monthly savings rate, even slightly, you're building dry powder for the future. That might mean cutting unnecessary expenses, starting a side hustle, temporarily avoiding major discretionary purchases. Cash isn't just safety. It's a weapon in times of uncertainty. If the market crashes or an asset class suddenly becomes undervalued, those with liquidity are in a position to buy when others are afraid. Buffett has often said, "Be fearful when others are greedy, and greedy when others are fearful." And today, as investors chase growth in speculative assets and ignore macro-level risks, Buffett is quietly sharpening his blade. You can do the same. 3. Stay invested. Stay disciplined. Stay calm. This may be the hardest and most important part of the playbook. Buffett has witnessed wars, crashes, bubbles, and recessions, and through it all, he has stayed invested. He doesn't let short-term noise derail a long-term plan. His discipline is what separates him from emotional investors who panic at every dip. Even now, while reducing exposure to certain U.S. assets, he still holds a strong position in solid American companies. He's not predicting collapse. He's preparing for a world where the returns we've grown used to may no longer come so easily. If you're building a long-term portfolio, this is not the time to pull everything out of the market or chase speculative trends. Instead, continue regular contributions to diversified index funds. Rebalance annually to maintain your desired asset allocation. Avoid emotionally driven decisions, especially after headlines shock the market. This is exactly how Buffett built his legacy, not by avoiding risk altogether, but by measuring it, understanding it, and adjusting with clarity. Bonus principle. Think generational, not quarterly. Buffett is almost 100 years old. He's not planning for the next 5 years. He's planning for a world that he may not live to see, but his investments will. That's a mindset shift every investor should embrace. Instead of thinking about your portfolio in terms of what it needs to do next year, ask, what do I want this capital to do in 20, 30, 40 years? How can it serve my family, my mission, my values? This mindset helps you zoom out, avoid reactionary mistakes, and stick to a strategy that works through every cycle. Buffett is still buying businesses with century-long time horizons. Even as he warns about currency and systemic risk, he's betting that human ingenuity, global demand, and innovation will continue creating value, especially for those who are patient and prepared. Final thoughts. Buffett's real legacy. This may be Buffett's last shareholder letter as CEO. But his legacy isn't just about returns or balance sheets. It's about clarity in the midst of chaos and action rooted in data, not drama. He's not trying to time the market or predict every twist of the global economy. He's building a foundation that can weather storms and thrive after them. That's something every investor, no matter how small their portfolio, can learn from. So take a moment and reflect. Are you diversified beyond your comfort zone? Do you have cash ready, not to hide from the world, but to engage with it? Are you sticking to the system or reacting to every headline? These are the questions that shape the next decade of wealth building. And whether you're just starting or decades into your investing journey, the answers you give yourself today may be the difference between surviving a downturn or transforming it into your greatest opportunity yet. And here's something worth considering as we wrap up. Most people who watch financial content never actually subscribe to the channels they find most valuable. If you found any insight here that helped you see the market differently or made you think more clearly about your next step, take a second to check if you're subscribed. And if you're not, hit that button and turn on notifications. That way, you'll be first to know when new videos drop, and you'll help others find these ideas too. Let's keep growing, learning, and investing together